Okay, terrific. Thank you. Hey, just listen. Good afternoon. Good afternoon, everyone. This is Mark from Right Line Trading, and I really appreciate your giving me your time today. What I'd like to show you is a really valuable tool that really can help you enter really low risk, high reward trades on multiple markets. And I'm going to go through all the parameters that it monitors in order to signal you a really excellent trade. Now, before I go any further, I just want to read the disclaimer that we are not licensed commodity trading advisors, and we ask you to seek financial advice before trading and never risk more than 2% of your account on any trade. And that although we post extremely accurate results with everything that we do, past performance is not indicative of future results, and and everything that we talk about here is really for educational purposes only. And with that said, let me just say a little bit about myself. I'm a graduate of the University of Pennsylvania, and I'm a former professor at Jefferson College in Philadelphia, and I published close to 15 peer-reviewed articles in first-tier journals, and I've been involved in the financial markets for over 20 years. And what Right Line Trading software does is it looks at all the forces that come to bear on price in any given financial market. And each of those forces are looked upon as being independent variables. And what we look at is each financial market as a closed system, with each force coming to bear on this closed system to create a fluctuation in price. Each of these independent variables are placed in a multivariable equation, and the equation is optimized. Now, the optimization of a multivariable equation is never completed because your goal is to create an equation that 100% predicts the future movement of price, and that really can never be achieved. What we look to do is consistently make its predictive power stronger and stronger, and this is really what mathematical modeling is all about. And that's what I really did in my graduate work. I did mathematical modeling for the U.S. Navy, optimizing underwater decompression schedules. And we are one of the fastest growing trading systems on NinjaTrader. We've pretty much thrown out all of the standard indicator analysis and all the things that have caused 95% of prior day traders to go bankrupt, and have really created a very unique and very different system. Now, what I would like to talk to you about today is called our Trade Analyzer. What I'm going to show you in the next 45 minutes, so I've got to talk quickly, is how the Trade Analyzer is going to find for you 4 or 5 or more low-risk, high-reward trading entries on any markets, because the forces that govern the movement of price on a financial instrument are market independent and time independent. If they really do work, it doesn't make any difference whether you trade a future, a Forex, or a stock, or use a stock to create an options position, or you trade a tick chart, a time chart, or a range bars, or you trade 1 hour, 2 hour, 5 hour, 3 minute, whatever. It doesn't matter. Now, you'll not be utilizing any of the indicators and chart patterns that you're likely to have been taught about, and I've created about a 95% failure rate in all of the prior generation of day traders. These are the things that just do not work. Now, oscillators do not work. An oscillator crossover Well, first let's talk about the fact that an oscillator can go overbought and stay overbought for days, depending on your time frame. It does not necessarily integrate in an overbought market, a great place to go short on a crossover. We all know how oscillator divergence is really a signal that oftentimes gets run over. Now, there's nothing about an oscillator crossover that inherently predicts that price is going to fall. I'm going to show you what really causes price to fall. But the oscillator only tells you where price has been. It never is able to tell you where price is going to go. The same is true for a MACD. MACD divergence is constantly getting run over. And a MACD crossover, when the MACD line crosses the signal line, in no way does that indicate that price is going to continue to rise if the crossover is to the upside, or price is going to fall if it's a crossover to the downside. It has no future predictive value. It just tells you where price has been, not where it's going to go. Fibonacci is just, I consider to be an immense hoax. People have been trading it for 20 years. No one's ever made any money off of it. Fibonacci transformations were created by an 11th century mathematician over 800 years before the rollout of any kind of financial markets. And this movement of Fibonacci into the markets, that somehow that these numbers are going to predict how price moves out into the future really is absurd from a scientific standpoint. Gann theory, is based on the fact that the market has an intrinsic harmonic, and it really has. At least Gann developed it for a market that actually had been invented, but it just doesn't work. Now, rising and falling triangles as signals to get you into a trade intrinsically have value because they create patterns, and we do want to be pattern traders. But rising and falling triangles alone work only some of the time, and they don't have the predictive value to make you a profitable trader. Just like pure price action, there's tons of traders out there and tons of gurus who tell you that trading pure price action is all you need to do. Throw away all your indicators and just follow me, and pure price action is not sufficient. Now, the real easy way is to trade momentum breakouts. It's the way to trade a $2 or $3 stock and hope for a $1 move, except that 70% of momentum breakouts fail, and it's really nothing more than a gimmick. It has never made traders money, and it never will. Now, there are really two key core trading principles, and that is we have to know what forces truly govern the future price movement on a financial instrument. And the trade analyzer that we look at to monitor 100 stocks or 24 Forex markets or multiple futures markets allows you to spot them. And the trade analyzer places the independent variables into an algorithm that shows you an entry trigger with an audible and visual alert. Now, here is a picture of the analyzer. And stacked. And I have Apple and CVS and Snapchat, and I believe CNI is a Canadian National Railway, and that's Home Depot, Alibaba, Advanced Micro Devices, and Target, and Palo Alto Networks. Now you can see that there's a kaleidoscope of colors, but the only thing that you're worried about is this orange alert, and when it flashes and beeps, that's when you have to open the chart or focus on the chart because you're going to get a really nice entry. Now, we're going to go over each of the independent variables that the analyzer monitors one at a time to show you how powerful the signal is. Today, our auto trader made over $700 on 3 trades. Now, it takes the same trades that the trade analyzer does, just independently. With the trade analyzer, remember, the auto trader is only optimized for 5 markets. on the trade analyzer, you can trade stocks, futures, Forex. So you have a lot more diversity, but the only difference is you have to press the button. Now, what it looks at is the multi-time frame analysis of trend, and I'm going to show you how critical that is. You want to take a trade when there's a multi-time frame alignment in trend. You want to take a trade when there's a multi-time frame alignment of correlative markets, which is a really specific indication of the direction of money flow. You want to look at the multi-time frame analysis of order flow, and I'm going to talk about each of these. The multi-time frame analysis of momentum, market profile, the dependent variables that are moved by these independent variables are the oscillator, MACD, Fibonacci, and Elliott wave. And if you use these to help you trade, they will simply degrade the precision of your trading. You will be forced to pass up winners, and they will walk you into losers. Now, the multi-time frame this should be analysis of trend, looks for a multi-time frame alignment, and it is a real critical independent variable. This is when you get your really juicy trades. Now, here's the trade analyzer. It's on Facebook, and it's blank. Now, when the first square goes red or green, what you have is a multi-time frame lock or alignment in trend. And for me, it's the most important independent variable that the trade analyzer watches, I watch, and the auto trader watches. Now, you can see that this chart has pink background bias. This is our bias indicator. Now, in most trading systems, on most software programs, price falls and the background will go pink or red. That doesn't tell you anything except what you already know, that price is falling. If the MACD crosses over and it goes pink, or if something happens with the oscillator and it goes pink, so what? What this background is doing is analyzing the direction of price on your two higher time frames. It doesn't even look at price on your trading chart. Now, if you're trading a 3-minute, it's looking at the 9-minute and the 27-minute. If you're trading a 1 hour, it's looking at a 3 hour to 9 hour. If you're trading an 8 range, it's looking at the two higher fib numbers. And Fibonacci has symmetry, but it doesn't predict price movement. So you're trading an 8 range, it's looking at a 13 range and a 21 range. That's locked in the algorithm of this indicator. Now, it also looks at the 50 simple moving average, 50 period simple, and the 15 period moving average. When the 50 is heading down, and it's red, and the 15 is heading down and it's red, and the 15 has crossed the 50 to the downside, the faster moving average has crossed the slower, and price is below both moving averages, so support is broken. On your two higher time frames, background bias goes pink. Now, believe me, if your two higher time frames are heading down, 50 and 15 are down, 15's crossed the 50 to the downside, price has broken all support, the only direction that you can trade on your trading chart is short. If you try to counter trend trade the direction of the two higher time frames, you're almost guaranteed to get stopped out. And that's what happens to all these traders in these counter trend green candles, trading oscillator divergence, MACD divergence, off of Fibonacci support, looking for a move up. They're going to get run over. Now, there's only one thing possible that can cause a multi-time frame alignment and trend, and that is the application of institutional money. Every closed system, and I don't want you to think it's esoteric, but a financial market is a closed system, and every closed system in nature That's a law of thermodynamics. Wants to move in chop. It wants to move to a state of maximum randomness when it's left to its own devices. And we know that every financial market we look at, every stock we trade, every futures market, every Forex market, chops about 70% of the time. You only get a trend, and you only get a multi-time frame alignment in trend, is when the institutional traders bring a lot of money to bear on these financial markets. That's when you get the alignment. That's when you want to trade, and you know the direction you must trade. Here's just the opposite. This is on Amgen, an 8 range from just a few days ago. Now here's the 50 and the 15. This is your trading chart. It's not being looked at by the screen. It's looking at the 50 and the 15 on the 13 range and the 50 and the 15 on the 21 range. Prices above them both. The 50's green, the 15's green. I'll talk to you about the system-generated entries, but the only direction you can trade is long. If you try to counter trend trade, you're going to get taken to the woodshed. Here's another down on the same day on Amgen. When this aligns to the downside, you got to go in that direction. Now, the multi-timeframe analysis of correlative markets is exceedingly important as well. It's another independent variable that predicts the future movement of price. You can see how the multi-timeframe alignment and trend is going to predict the direction you have to trade, because it's going to predict that it's predicting that price is going to move in the direction of the 2 higher time frames. Now, correlative markets, when they align, are going to give you 2 more reds: quant 1, quant 2, quant 3. And what they do is, we know that when certain stocks fall, though these are the 3 quant lines, and what they do is they look at 9 correlative markets. Now, the correlative markets either move in the same direction as Amgen or in the counter trend direction as Amgen. And there's quite a few websites that just list out markets that either correlate with Amgen or correlate with Amgen in the inverse direction. And all this is telling you is that in the course of a given day, what all the institutional traders do is rotate their money from asset class to asset class, or groups of stocks to groups of stocks. The amount of money in the financial markets in a given day is pretty much fixed. So when all the stocks or ETFs or other markets that fall when Amgen falls are falling, and when all the markets that should rise when Amgen is falling, these 3 lines go red, red, red. And that's telling you is that money is moving out of Amgen and its correlative markets and into the markets that inversely correlate. And what it's doing is tracking the movement of institutional money from Amgen and its co-partners in this asset class to another asset class. It's another independent variable to help you above and beyond background bias. In other words, we're adding more and more specificity to your trading. It must comport with now an additional rule before the analyzer will alert you and you're able to take a low-risk trade. Same thing again with Apple, the same slide. Now you're seeing that oftentimes when there's a multi-time frame alignment and trend, it's because the institutional traders are rotating money into Apple and its partners in this particular asset class and out of the markets that inversely correlate with Apple. Here's a move on Best Buy. Red, 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 money's flowing out, background bias is aligned to the downside. The risk of trading gets lower and lower as we layer these independent variables or independent forces that govern the future movement of price on top of each other. Now, the 15-period moving average we use is proprietary. And what it really is a combination of a moving average and an ADX-ADR indicator. And it's really important because the ADX-ADR indicator doesn't call entries. It doesn't tell you when there's a top or a bottom. All it does is measure volatility. So what we want to do is we want to take a trade. Now, here's line 15. That's our 15-period proprietary moving average, and it's called the RL trend. Now you've got more red moving across the analyzer as these forces align. Now, we want to take a trade when this line is red, because it not only acts as an area of resistance to the upside or support as prices or is coming down to it, it also reflects to you that there's sufficient volatility in the market to have nice movement. I mean, day traders and swing traders rely on volatility. I mean, if there's no volatility and the market is flat, the prevalence of a winning trade is exceedingly low. So when this moving average is yellow, it's still acting as strong support and resistance, but it's telling you there is insufficient volatility present in the market for you to get a low-risk trade. So you have to wait for red and red to get your short trade. It's a third independent variable. There's a long trade on green. This line must be green for the trade analyzer to signal you a long trade. There's your down. This must be red. Once it flattens here, you see how volatility falls? Eventually it picks back up, and you can only trade again when it's red. Now what happens? Now we've only gone over 4 independent variables: volatility, the multi-timeframe alignment of trend, and money flow. What happens when forces that govern price movement don't align? And I kind of really already alluded to that. Here's what happens. The market just moves in chop. This is Expedia. And this is the time you want to sit on your hands and stay away from the mouse. Because all those forces that are bringing pressure to bear on Expedia are all a mess. They're not aligned, and all Expedia is going to do is chop. We're going to let the other guys trade Expedia right now. We're going to stand clear. Now we have volume. Now we have to assess volume. Volume is a really important metric. We must make sure that there's sufficient volume to take a low-risk trade. If there's low volume, and we have a special volume analysis, then stand clear and you will not get a trade. So there are other independent variables that we don't visualize right on the analyzer because it'd be too many colors flashing. It'd be like a kaleidoscope. 2 more are the multi-timeframe alignment of momentum, and the other is the multi-timeframe alignment of order flow. These are 2 very important independent variables. It's assessed here, and it's all we look at are the 2 higher time frames. You'll notice that nothing we do or analyze utilizes price or price movement from your trading chart. We either look at higher time frames, or we look at other markets, or you're going to see we look at other metrics. Now, when momentum is aligned to the downside on your 2 higher time frames, it's red. This line is red. Now, There's a lot of ways to assess momentum. You can use a MACD, and that's good for momentum. Oscillator is great for momentum, and I've heard some people say it's not a momentum indicator. Most definitely is a momentum indicator. But we use Heikin-Ashi, a modified Heikin-Ashi formula. And I feel it's just the most precise, and it's the most helpful. Order flow, which is the bottom line, tells you, are there more buyers or sellers on the bid-ask side of the trading dome? Now, what we do is the disparity in the number of traders on the bid and the number of traders on the ask is known as the market delta. And if you've ever seen a line that tracks market delta on your trading chart, it has no predictive value whatsoever, and it's just really, honest to God, it's a mess. What we do is we put the delta value that's present on the close of a candle into a moving average, and we create a delta moving average. And when both delta moving averages on your higher time frame are to the downside, it means there's a significant selling pressure. There's a significantly greater number of traders looking to sell than looking to buy. Here, more traders looking to buy than looking to sell. So when both of these align and you break resistance to the upside, again, you have only one direction to trade, and that's long. And if you try to counter trend trade, you're going to get run over. Now, the analyzer will only trade when order flow and momentum align to the upside or the downside. And here's another trade. I took out the instrument. I took out the time frame because it's irrelevant. If these are daily bars, 4-hour bars, 8-range bars, it doesn't matter. When order flow and momentum align, you must trade long. And I don't counter trend trade, but if you want to, the only opportunity you're going to have to even have a ghost of a chance is when order flow and momentum align to the downside and give you the opportunity to reverse direction. Now, what happens when these two independent variables don't agree? Remember, I showed you what happened when none of them agreed. What happens when just these two don't agree? We get chop. They're both equal in power, and when one is calling, when momentum is telling you short and order flow is telling you long, the market just moves in chop. The ability to get a winning trade diminishes greatly. You wait for them to align, the trade analyzer's watching, and there's your price direction. There's the direction you must trade. And again, we have not discussed getting into the trade or a trading entry. We're simply giving a direction. Multi-time frame alignment of trend, the direction of money flow, enough volatility as marked out by our right line trend indicator here, our modified 15-period moving average, and order flow and momentum. Now again, when they don't align, markets chop. When they align, up you go. Here's just a little bit of I took this off the E-mini, but it doesn't make any difference. I mean, I could obliterate this and you wouldn't know what market it was, and it would still be the same. When order flow and momentum alone, this is just order flow, is red, and that's all you're looking at, the only thing you can do is trade to the short side. You break support, you break resistance, you trade down to support. You have this little area here where you go long, you trade up off support. Eventually price comes up to resistance and you trade short, always in the direction of order flow. Can't trade against this line, and I never do. Now the cash metrics are really, they're unique. We've been working on them, and we're working on them again now because we're tweaking them because we believe that they already have tremendous predictive value. We believe that they are really going to be one of the premier indicators ever created, and no one else has them, and they're part of the analyzer. And what they are 16 indices broken into 4 groups. The 4 groups are the Dow, NASDAQ, S&P, and Russell. Now these can be used to trade the futures or stocks, and they're very powerful on stocks. And the futures market too. 8 are volume-based, and 8 are tick-based. And what they look at is the ratio of stocks moving on up volume versus stocks moving on down volume. And they create a delta. And we plot that delta. They look at the ratio of stocks advancing to stocks declining. It creates a delta, and we plot that delta. It looks at the ratio of stocks on the uptick versus stocks on the downtick. Again, we have a delta, and we create a moving average of that delta. We look at the ratio of advancing declining line to specific ETFs and specific indices like the semiconductor index. And we look at the same thing with upticking and downticking stocks and specific ETFs. And here are just some of the indices that we track. Now, it turns out that there's 8 metrics here, and the tick data tends to be fast. The volume data, for some reason, tends to be slow. And I don't know why that is, but the volume data just tends to sit, and the color is fairly stable, where the tick data, or the tick color, and the tick alignment is more transient. But when you get a green-green alignment, it's a very powerful signal, and this is a real leading indicator. When you get green-green, and you get 16 metrics, 8 tick and 8 volume in a given market, all aligning, it tells you that market's about to explode to the upside, and it does. So this doesn't lag the market or tell you where it's been. It tells you where it's going. Now here are the 2 green lines, and this is Apple. Well, it's got the background bias, it's got the 15 green, but really what I wanted you to really do is pay attention to the cash metrics, the 16 metrics that we look at. Now, I want you to see actual trade analyzer generated entries. Now, this is a strategy entry. We don't ever use the analysis of a single time frame to generate anything. It's a multi-time frame. The signal looks at multiple time frames, and it looks at 3 time frames, and it analyzes price action and market structure, its distance from support or resistance, a whole bunch of different parameters. And when it occurs intra-candle and everything else is aligned, that's when the analyzer is going to give you an entry. This is a real powerful entry signal, and you don't get a lot of them in the course of a day. And in a choppy day, you may not see any. This is a consolidation signal, and you can see how price has gone into consolidation here. You have an up candle, 3 down candles, a doji, and an up candle. Volatility is dropped. Price is moving sideways. And what happens in consolidation is the price of the bulls equals the power of the bulls equals the power of the bears. But consolidation almost always breaks out in the direction of the trend, which is the direction that the institutional traders are pushing the market. Now, everybody else will be in the candle that actually breaks consolidation. But because this indicator looks at multiple time frames, it can predict when consolidation is going to break, and it does so with incredible precision. and you would take the trade one tick above the close of this candle long right here, and the analyzer would be beeping and flashing for you, and you have plenty of time. This candle would only be a ticker formed by a tick or two. If it doesn't mature to the upside, your buy stop will never get triggered. And lastly is our C candle. This is the only entry that does only analyze one time frame. And what it leverages is this. In price action, any two candles in a row create a trend. The software knows it, and it plots that A. I didn't put that in there. That's a software-generated A. The software then looks for a counter-trend candle. These are traders doing what we are not going to ever do again. Use oscillator divergence to call a bottom. Use MACD divergence to call a bottom. Fibonacci support to call a bottom. Get caught in the counter-trend direction to the direction of institutional money. We wait for the C candle. The C starts to flash. The buzzer goes off. The analyzer starts to blink. You put your trade in one tick below the close of the candle. If it matures to the downside, you've got yourself a great short trade. Very, very low risk. Price is pushed down by two forces, the addition of additional sellers, and by the fact that all of these traders in the counter trend direction are going to get stopped out. And here's an alert on AMD. You're going to grab that chart, look at the entry, and put your trade in on a short, one tick below the close, on a long, one tick above the close of the entry candle. Now here are just a few trades. This is on Facebook. Here's the strategy entry. It gives you 40 cents on 10 cents of risk. Now this is how you day trade stocks. You don't use gimmicks. I'm going to show you a couple other things real quickly because I don't want to run out of time. This is on Perrygo when I pull back to support of the value area high, 75 cents on 10 cents of risk. The risk to reward here is incredible. I mean, if you trade 1,000 shares, you're going to make a mint. And if you trade 100 shares, you'll make really good money. For the risk that you take, the reward is incredible. Here's a short on Tesla. For 15 cents of risk, you make 65 cents. Now here's a short on Netflix. The C candle off resistance, that red, 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 background's red. Now I just called it a buck here, but if your risk tolerance was greater, you could have taken the trade all the way down to here. And that would have been over a $2.25 trade on 15 cents of risk. Apple, 78 cents on 15 cents of risk. Here's Akamai, C candle short, 30 cents on 7 cents of risk. Wynn Resorts, which I really like to trade, Wynn, Bank of America, Delta Airlines, really low beta stocks, they trend. I mean, we always like to put in a couple of high betas, Facebook, Netflix. It's tough to trade Google, Amazon, they're way too expensive. But trading these stocks that are low beta stocks make you good money as well. This is 29 cents on 7 cents of risk. You get 2 or 3 or 4 of these. You made a buck. On 100 shares, it's $100. On 1,000 shares, you made $1,000 bucks. Here's Tesla again to the downside. Now, I want to just give you, this is going to be the last thing, because it's 2:25, and I think that I stop at 2:30. You get all kinds of information about how to trade gaps. Now, let me just give you a little bit of a heads up on a gap. Any gap that's created pre-market there's nothing here to analyze. Who creates a gap pre-market? It's the small commercial traders like us. And we really don't hold sway over the market. What we do pre-market is pretty much irrelevant. The only thing that's right, you can't assess a gap pre-market. You can't make any comment about a gap pre-market because the institutional traders are not involved in a pre-market gap. They can't trade, they don't trade because there's no liquidity. But when the cash metrics, 16 market internals, are aligned to the upside, this gap down at market open becomes a gap up that's going to run. That's the scientific way of trading a gap. And this is a buck gap on a fairly inexpensive stock. Very lucrative trade with a very low risk. Here's a market open on the alignment. It's going to run to the upside. This doesn't happen often, but when it does, you can trade the market right at the open on a fly to the upside. And here's another. Now, I always get the question, can I swing trade? If you notice, it's just 912, 913, 914. These are hour candles, and this is a 3-day trade. And that's $1.10 on a $15.90 stock, as long as the cash metrics allow it. So I just wanted to give you 2 quick testimonials. Tons of people throwing testimonials. I'm going to talk, let me go really quickly. This is a Jersey Tony. He's a top step trader. He's been with us 2.5 years. He makes great money. This is Trader D. He won the Top Step Trader 216 games. He made the most money of anyone else in the country. He loves our system. Now, and these are, I mean, this is all the stuff that they talk about. He went 21 straight days without a loss. Now, here, as we look at the multi-timeframe assessment of trend, market internals, we assess order flow, momentum, strategy, momentum, and C-candle entry. And here's the deal we put together. Now, the trade scanner package consists of this. First of all, it's normally $6,000, and that's what it is on our website, because you get all the software. The software is required for the trade scanner to read, to create the entry. Now, the first bonus is we're going to put you in the live trading room with me for 3 months. And no matter what instruments you trade, I promise you, it will help you greatly become a real disciplined trader. You'll learn our methodology, you'll learn how we trade, and you'll learn how to leverage all the tools that we use. You also get our trade execution platform. It's a patent pending tool. It's a lifetime license. It's going to let you get into the trades with incredible precision. I press the button and you press the button, and you're going to get the same entry that I get. All our trades in the room are tracked with ChartTrader. And I show my NinjaTrader back end at the end of the session, always. This is a terrific tool. I'm waiting for patent approval. And also, you're going to come into our trading school. We have a lot of people in there who just buy the school, but we're going to let you come in, and you're going to take the 10 weekly didactic live trading sessions with me, and I'm going to teach you from the ground up how to trade right. We're going to get rid of all the stuff that's been in your way and really giving you problems. Then you're going to get total access to our video tutorial library. It's 400 videos. And you put them all together. What we're going to ask you for is $29.99 or 2 payments of $15.50 a month apart. Now, the first 5, get that 10 module educational series. You only get that if you're one of the first 5 orders. Otherwise, get everything else, but you don't get trading school. Now, the offer expires on November 2nd. Now, here's our email address, our website, our email address and our phone number. And why do that? I'm going to answer 60 seconds worth of questions because it's 2:31 and I got negative time left. Let me just see if there are any questions here. Okay, hang on. I'm sorry. Let me just go back. It'll take me 60 seconds to answer this. Yes, it is recorded. Okay, hang on. I mean, there are a lot of questions. I'm going to try to go through them. I just don't want to run over. Okay, here we go. We are right line trading, Caesar. Okay, you're talking to Wally. Wally is a great guy. Okay, here we go. Eight range means Manpreet that the candle has to move 8 ticks, 8 cents, or 8 pips in order to create a new candle. It'll work with Thinkorswim, JP. Caesar, we use an 8 range, a 13 range, or a 21 range. I use I use NinjaTrader, but we work on Sierra and we work on Thinkorswim. Okay, everyone, listen, thank you so much. I really appreciate your time. If you have any other questions, you give us a call at 786-713-5276. We'll be more than happy to answer any of your questions. So let me turn this over. Thank you so much for your time, and have a really wonderful day. Take care.